By the way, we're going to be recording this lecture. I need more English language content. So there's a camera over there. And it's only going to be the back of your head, so no problem. If you have any questions, feel free to ask. My name is Roman Busko. I'm a friend of Ilya. We know each other for 10 years. So we met each other in a small office of a law firm, and we used to go out to drink beer together back in St. Petersburg. So I have a lot of funny, embarrassing pictures of him from back in the days, which I'm going to demonstrate at the end of the lecture, if he doesn't mind. And indeed, I've been practicing law for almost 10 years, and I've been focusing on crypto since 2016 approximately. And Ilya gave me a broad mandate and discretion on what to talk about within crypto. And I decided to structure the lecture in the following ways. We're going to go through the main narratives in crypto, which are 3 of them. And I will ask and I will pose the main sort of a legal or societal or economic questions that are posed by this technology. And this is a good, I think, starting point if you want to write a thesis about an interesting topic. I think that's a good starting point for you. And yeah, as Ilya said, As Ilya said, I'm the founder of a law firm where we do different corporate and investment stuff. I'm also building a platform which is supposed to be an all-in-one legal platform for technology startups, which I hope you're going to hear a lot in a couple of years, but that's still in the works. Disclaimer, contents. Okay. So I will start with the market overview, then go to Bitcoin as the main narrative in crypto, then to smart contracts, stable coins. And then I also have like almost 20 slides about top 10 crypto law highlights of 2023, but I'm not going to show you them because it will take another hour. You can go through them afterwards. Also, we're going to share the presentation, the slides with everyone, so you can read through them. And I'm sure you will want to do that because some of them has too much of information. And within smart contracts, we will consider 5 narratives: token issuance, decentralized finance, decentralized autonomous organizations, tokenizations of RWA or real-world assets, and decentralized social networks and reputation, which I find the most interesting. Before I go to market overview, let me ask you a few questions. So which of you have not heard about cryptocurrencies before this lecture, before today? All of you, yeah, I guess, heard about crypto. Which of you have actually any crypto on exchange or wallet or anywhere? Who? Raise a hand. You? Okay.
I invested a little bit.
You what?
I invested a little bit in
Hello.
Bitcoin and Ethereum.
Yeah, all right. So do you have an account on an exchange?
Yeah.
Okay, and that's the only one person? Okay, you guys, and even you, Ilya.
I do.
You've been teaching this for years and you still don't have any crypto.
I think it's just maybe some people may not want to share, right? So it's absolutely fine.
Yeah. All right, so I think it's a really interesting, I'm not going to ask you all other questions, but do you have like a crypto wallet like MetaMask, or maybe have you done a transaction?
Yeah, MetaMask, and also I have an account in the Binance.
Binance, okay. Have you done a transaction on a decentralized exchange like Uniswap?
Yeah.
Yeah? Okay. So, okay, you're in the top 1% of the world population of who understand crypto. Oh, okay. No, great. So yeah, let me give you a brief sort of the general picture. Today, the total market cap or market capitalization of all crypto assets stand at approximately $2.3 trillion US. That's a lot of money, but it used to be more. In 2022, it used to be 3 trillion, and I think we'll gradually approach that number within the next 12 months, maybe even sooner. And is that a lot? Yeah, that sounds like a lot of money. But in fact, if you look at the total market cap of all financial assets in the world, it's only 1%, even less than 1%, approximately half a percent. And that's a ugly, I know, pie chart, but it stands to represent all the bonds, equity, private markets, gold, silver, and major currencies out there in circulation, which account for approximately $300 trillion US, of which crypto represent only 1%. On the one hand, 1% is a small number. On the other hand, 1% is gold. You can see here, gold represents 5% of all the assets in circulation, and crypto already like 1/5 of all the gold in circulation. So that's quite a significant number and share. And what is the total market structure of crypto. That chart, or that chart stands to represent the entire crypto market capitalization out there. Out of those 2.3 trillion, 54% is dominated and is run by Bitcoin. And Bitcoin stands to represent a simple narrative that Bitcoin is a new digital gold. That's you would say, the dominant narrative in crypto, that there is a new type of gold out there, which is Bitcoin. And the second narrative is smart contracts, or Ethereum, Solana, and other smart contracts platforms. And this idea and this narrative represents 23% of the entire total market capitalization. The third largest segment and use case of crypto is stablecoins, payments and USD balances without the banks. That's the narrative that stablecoins are supposed to represent. And as one of the speakers said at the beginning, while there are 23,000 or even more crypto assets in the world, most of them represent one of those three ideas: a new digital gold, smart contracts, stablecoins, and everything else. Probably the rest of those 23,000, except for these several few, are in this small group of everything else, 7%. So while there are so many assets, you really need to focus and understand the three basic ideas before you even discuss those like meme coins, decentralized physical infrastructure, and all other ideas that tend to pop up in crypto every other week.
I wonder, when you talk about the market cap, how much of these coins are lost forever, for instance, or these dormant addresses that are never used, or the access is lost.
Right. So the market cap is essentially when you multiply the price of one Bitcoin, but all Bitcoins in circulation. As you point out, there are indeed some lost Bitcoins, or deemed to be lost. At least the wallet of Satoshi Nakamoto, the founder, has never moved a single coin, so it just stays there. And some people think that the market cap should be bigger because you need to deduct those coins, and then the price of one coin should increase proportionally because of that. But that's a good thought experiment. But for the ease of reference, I think you can just say that it represents 54%. All right, let's go to Bitcoin. Now you have a general picture. There are three main narratives within crypto. And let's talk a little bit about Bitcoin. And I want to tell you that Bitcoin has been around for 15 years. That's quite a lot of time. And the first Bitcoin was mined back in 2009 in January. And I think that and the last crypto major event in crypto happened this year in January, when the first Bitcoin ETF was approved. And the approval of ETF, I think, signified the date when Bitcoin has become a global accepted financial asset, just like the gold and many other commodities like silver, oil, and many other things. And so that you understand, if we assume that the average life expectancy in the world is 73 years, it means that approximately 20% of the world's population are born when Bitcoin already existed. That means that your younger children, brothers, sisters, maybe children, are in this world when Bitcoin is already in place. So you don't have to explain to them. I have a younger brother who is 10 years old who knows the price of Bitcoin. He probably knows it's better than the price of US dollar, because for him it's a reality that he was born into. And that's an important aspect, because I will claim that the price of Bitcoin and the acceptance and adoption of Bitcoin is a social concept. The longer Bitcoin exists, with every year, the more accepted it is and the more widespread. And when I say this, I will also say that gold is a social concept. And when people hear, they usually exclaim and say, hey, how gold is a social concept? Gold has a consumptive utilitarian use. You can use gold in let's say, microchips and in production of, different things. And let's say, imagine there is like a lot of gold developed and mined every year. How many of the gold consumed every year is used in microchips and in production, in facilities and consumptive industrial use? What is the percentage of the total gold produced in 1 year? How big is the percentage of it is used in production? And there are several use cases. Let me tell you. There's the jewelry. There's a purchase by central banks, when central banks buy gold for their reserves. And there is a industrial consumptive use, like microchips. What is the percentage approximately, in your opinion, per year, of all the gold developed and mined per year? roughly?
Probably low, I'd say 30%, perhaps.
30.
It's
Okay, any other guesses? 5. Well, you're almost right, actually. It's actually 7%, 6%. Only 6% of the all gold mined per year go to microchips, and actually a significant portion would go to dentistry to produce gold teeth. If you go to the website, the link is here, to the World Gold Union, you can find a special line there that approximately 10 metric tons of gold go to produce gold teeth per year. But the important thing here is that 46%, almost the half of gold in production per year, is used for jewelry purposes. And people buy jewelry because they want to signal their status, or they want to signal their gratitude or their affection to somebody they want to give a gift to, like a wedding ring, right? Another quarter, 25, almost 23%, are purchased by central banks, like Central Bank of China, Russia. They buy so-called reserves, gold reserves and currency reserves. They buy the bars, the actual physical bars, to store within their treasuries. They buy the gold not because the gold has per se any value or use or central bank is going to spend on something, but because the value of the gold is so stable, because it's been in circulation for thousands of years, so that central banks buy a quarter of all the gold produced and mined every year. And another quarter, bars and coins, that's when individuals buy gold for investment purposes. That's the same as central banks buy for their treasuries. That's when individuals buy. Most of them, I guess, live in Switzerland, but some people actually do buy bars and coins, gold bars and coins. And only 6% is actually used in technology. So when somebody will tell you that gold is very different from Bitcoin because gold is actually used in microchips, you should remember that only a small percentage of gold is used in microchips, and the rest is about a social concept that gold is valuable. And I will claim that Bitcoin, with every year passing, Bitcoin will gain attention and acceptance that in a similar fashion as gold has become a global store of value. And Bitcoin has validated its store of value status and commodity status this year when the first application, when the application to create ETFs were finally approved, and there were, as far as I remember, approximately 12 or 13 ETFs approved on the same day. On the chart on the right side of the screen, you can see the price of gold when it was, what happened with the price of gold when the first ETF for gold was approved in 2004. And all the Bitcoiners love this chart very much because they think that the price of Bitcoin will skyrocket the same way. You can see that in 2004, the price, the first ETF for gold was approved, and the price went from $400 to approximately, I think, $2,300. Oh no, it's $1,800 per 1 ounce. Right. That's the major event that happened in the world of crypto last year, and I think you will see more and more happening like this, because I think in Hong Kong it was approved only last week and began trading. And the big societal question and the legal application here is whether Bitcoin will continue gaining market share at the expense of other store of value assets such as gold. And will actually, the second question, will nation states accept Bitcoin as a legal tender, and will they add Bitcoin to their sovereign reserves? And we already see examples of this in small countries like El Salvador. They adopted Bitcoin as a legal tender and started mining and accepting Bitcoin in their national reserves. I think that was a big event that happened a couple of years ago, and I'm sure we will see more of that. The problem with Bitcoin is that it's a quite useless asset. Some people call it a digital stone. You can't really do anything with Bitcoin except to store it and see it grow, right? There is nothing happening in the land of Bitcoin. But there is some caveats, by the way, because some people are actually trying to develop some new applications for Bitcoin. And that's why the idea for smart contracts came about, because as opposed to Bitcoin, with smart contracts you can actually code and transfer the assets based on the predetermined transactions and parameters set within this code existing on a blockchain. And that's how we go to smart contracts. And the term was first introduced by Nick Szabo in 1994. I put the picture of this guy on screen because many people think that he's the original Satoshi Nakamoto. because he came up with all the ideas that Satoshi came up, but only 15 years before him. So probably you should remember his name, and at a certain point in the future, we'll think that he was the Satoshi.
The guy who was
No, not this one. Not this one. But the idea, in 1994, he said that smart contracts are computerized transaction protocols that execute the terms of a contract, and he included the vending machines into the term of the smart contracts. But the idea really took off with the launch of Ethereum and so-called Ethereum virtual machine back in 2014-15. And nowadays there are several smart contract platforms. The most popular of them are Ethereum and Solana, and they are used for different purposes. For you lawyers, I think it's important to understand, for us lawyers, right? Not only you, but although I studied in the business school, I regard myself as a lawyer as well. It's important to understand that smart contracts are neither smart nor contracts per legal sense of this word, because they're as smart as the code written within those smart contracts, and probably any software that we use today, like this Adobe Acrobat, PowerPoint, everything is much smarter than any traditional, the most advanced smart contract out there. The smart contract, the code of smart contracts is really simple. It's the code that probably, while it's kind of simple, it does simple functions, it has own difficulties, but let me put it this way, they're not as smart as people call them. And they're also not contracts in the legal sense of this word. It's not about rights and obligations encoded within the blockchain. The best way to think about this is that this is some sort of a small piece of software that is run on a decentralized computer. And the very fact, the most important fact is they are run on a decentralized computer or not a centralized server, and they cannot be shut down by the government, or they cannot be shut down by individual, and they sort of exist. They exist in the cloud. Let's put it this way. And as I said in the beginning, we're going to go through 5 use cases for smart contracts. The first use case for smart contracts was the issuance of tokens back in 2017. The first one was Ethereum. Ethereum raised several dozens of millions of dollars during their token sale, and then this kind of and galvanized the society that you can use and issue tokens as a way to raise financing for different projects. And on the right side you can see a chart, the total funds raised during the ICO bubble. ICO stands for initial coin offering, just like IPO, initial public offering. And indeed those tokens, the smart contracts, enable the issuance of tokens, some sort of tokens. You can call them asset reference tokens, other tokens, or any other within the MiCA classification. And that was fundamentally the idea that you can raise financing from a general public, just like an IPO, but for the product or startup that does not have a product market fit. Because usually you only do the IPO when you have a product market fit, you have a validated, business hypothesis, you have the auditors, everything. And in this case, the ICO was done for products or for startups that didn't have any product market fit or didn't have any business model. And that led that there came a lot of scammers that tried to raise financing for the projects that were not viable, which made the regulators very nervous about that, because all of a sudden there were a lot of people from the general public that started losing money. And that's when the SEC stands for Securities and Exchange Commission. That's the main regulator in the crypto industry. Fortunately or unfortunately, you can think that ESMA is the main one, but SEC has been there for a long time and tends to dictate all the policies and all the practices in the world. And that's when they began their crusade against token issuers. In the United States, they apply the so-called Howey test to define whether something is a security. And token issuers try to say that token is not a security. SEC says it is a security, and there is an entire fight and battle and war on what a security is. And I think that will take a lot of time for this to settle. Probably this case will go to the Supreme Court in the United States. But the Howey test says that anything can be a security if it meets the following 4 prongs: investment of money in a common enterprise with expectation of profits from the efforts of others. And lawyers or their clients spend billions on legal fees fighting about these 4 elements, and each element and sub-element of this test, whether someone is a common enterprise, whether there is expectation of profit. There have been around many cases. And on the left side of the screen you can see like a small sort of a representation that sometimes the analysis is really complicated by the fact that there is a token, there is a contract to issue a token, and there are facts and circumstances surrounding the sale of the token. And from the perspective of the regulator, anything of that can be a security. And what SEC does, they say that the entire transaction or the entire, let's say, scheme was an investment contract and thus a security, and thus every token is a security. And if every token is a security, then Binance is an exchange that should be regulated, because Binance all of a sudden lists securities on their exchange. That's actually the ongoing fight that goes right now in the States, where SEC is suing all the centralized exchanges, including Binance, Coinbase, Kraken, because they list tokens, and SEC says that these tokens are securities, thus the exchanges should be licensed as national securities. All right, and the two fundamental questions that are posed by this development of token issuance and ICO is whether the issuance of tokens as a form of early stage financing requires a new regulatory approach. And you can see that MiCA has actually offered a new way to do this, and the emphasis in MiCA is on the disclosure standards, the so-called white paper. That's the fundamental idea, that we need to disclose a lot of information so that people can make an informed judgment about whether to buy those tokens or not. And the second question, less relevant for this class, is whether the definition of the accredited investor should be based on wealth, not on, or should be based on knowledge and not on wealth. Because if we change the definition of accredited investors and based on knowledge, we increase the potential pool of investors, of accredited investors in the world, and this question becomes less relevant who is participating in those transactions. All right, so the second big use case for smart contracts was decentralized autonomous organizations, because those tokens enabled not only participation, but also voting, and by the fact that you can vote using token, that led to the idea of creating digitally native organizations with token-enabled decision-making. And the first major DAO was called the DAO, and it was eventually hacked in 2000, I believe, 15, 16, something like this. And then the SEC issued a report saying that all DAO tokens are securities, thus they should be shut down, and we need to, you need to get approval to set up a DAO. But I think a lot of people actually confuse what a DAO is and how it's different from a typical, let's say, Facebook chat or group, or let's say WhatsApp chat. And here I listed different criteria based on which you can compare a WhatsApp chat. Let's say you get together to select a present for your friend, right? You want to pick up and discuss and collect the money in a WhatsApp chat, to collect the money to buy a gift for your friend, right? How it's different from a DAO. And because both are interest-based communities, right? You have certain interests that the audience is centered about. They are both digitally or internet natives. They exist on the web, on some sort of a social network. They both have some sort of a voting mechanism. What the differences are is about the fundraising. With the DAO, it's much easier to raise financing because you can issue tokens, and those funds that you raise, they're stored in the treasury, and the access to this treasury is usually governed by so-called multi-signature wallets, where you enable a transaction where, let's say, 2 out of 3 signatures sign that specific transaction. And I think the other fundamental difference is that DAOs can create smart contracts, can deploy smart contracts, and smart contracts govern this one is a bit more complicated, but with a WhatsApp chat, you can't really do anything within the internet or within the blockchain world. You need to take those money, buy a gift, present a gift to, let's say, Ilya or somebody else. With a DAO, you can deploy a smart contract and govern the smart contract. For instance, all the major decentralized exchanges or protocols are governed by DAOs. They decide the parameters and they deploy and update smart contracts. And once the DAOs took off, many jurisdictions began competing to become the next deliverer for DAOs. And here you see the timeline of different approaches on how to create and establish a DAO, because all of a sudden DAOs understand that they actually need a legal entity to shield them from the potential liability that can emerge from their actions. The first one being the Swiss foundations back in 2014 that were used by Ethereum. Then we had Offshore Trust plus C Corps, United States C Corps, then United States US LLCs were used, and this keeps developing. Every now and then a different jurisdiction comes up with a new special legislation for DAO, and in my view, these are pretty much useless. You can use a typical LLC in Delaware for these purposes, but anyway, they tend to come up every now and then. I think as recently as a couple months ago, Wyoming has adopted a new legislation specifically for DAOs. The big questions here are whether DAOs are superior to existing forms of collaboration in the digital world, and whether DAOs should have legal personality and can be subject to liability. How is it different? Yeah, I think it's a potentially interesting topic for the thesis. Are DAOs supposed to have a legal personality, and how can members of the DAO be held liable for the actions of the DAO? There is actually one case where the DAO was held liable for the breach of the United States law, so-called UkiDAO. They deployed a protocol, and the members of the DAO were held liable, and the court decided they have to pay a small amount of money for participating in this DAO and breaking the law. All right, so that was about the decentralized autonomous organizations, and the next big thing is decentralized finance. As I said in the beginning, smart contracts are very primitive programs, but one thing they can do well is that they can track the balance of the accounts and exchange between the different balances and wallets, the different tokens. Right, so that's why the decentralized exchange was the first application in the decentralized finance industry. Here on the screen you can see two standard applications. On the left side it's Interactive Brokers. That's the typical brokerage account. I guess some of you own some sort of a stocks or bonds or equities. That's what you usually see in your broker application. On the right side of the screen you can see the same application but for crypto and digital assets, which is called a Uniswap app. They on the surface they look completely the same, no difference. You have the balance, you have the different assets, you have the chart that goes up and down. Both of them are pieces of some sort of a software that is behind this interface. The fundamental difference is that with a typical brokerage account, this software is stored on centralized and is stored and run on centralized servers, most likely Amazon Web Services or Google Cloud and Microsoft Azure. With smart contracts and decentralized exchanges, these smart contracts are run and stored on a network of computers all around the globe. It means that no specific government and no specific individual can shut them down, as opposed to centralized servers, let's say, that are built in different locations in the world. And the big questions here: can all existing financial services be replicated on smart contracts? And if so, should DeFi protocols require a license? Should DeFi developers require a license to deploy, develop, and run smart contracts that tend to replicate financial functions? And what is decentralization? Because decentralization is the holy grail of the entire crypto industry, that tends and want to rely on the idea that if something is sufficiently decentralized, it does not require a license. And in the United States, there is some sort of a precedent for that. In 2018, one of the high-level officials stated that if something becomes sufficiently decentralized, it sort of gets immunity from being regulated. In MiCA, in preamble of MiCA, there is a phrase that services provided in sufficiently decentralized manner do not require a license. And nobody knows what is a sufficiently decentralized means. How do you deploy a protocol? Because you need to write some code and push the button to deploy the code. And does that mean that something is sufficiently decentralized after that? Do you need a license to deploy the protocol, or do you need a license to update the protocol? Nobody knows, and I think authorities are actually tasked to come up with an idea or with some sort of how to call this, like accompanying legislation that's supposed to explain and define what decentralization.
Can I ask about
Yep.
the Uniswap? So the Uniswap, I get it, it's decentralized, but the application is owned by somebody, right? So there is a Uniswap lab and that. Yeah,
the idea is that the application itself and the interface is owned by Uniswap Labs and it's run on the protocol, but anybody can build the same application that connects to this protocol. And in theory, it could be anybody else, not necessarily a Uniswap Labs, that taps into the protocol and visualizes all the transactions on the protocol and enables the the payments, the exchange, the everything.
Yeah, perhaps the first thing to regulate would be these interfaces.
Yeah, why would you regulate? It's just an app.
So it's just an access point.
Kinda, yeah.
Well, if and there has been cases where some coins, shit coins, were sold through Uniswap.
Right.
Uniswap Lab could limit access to those through the application, right?
Yeah, you're giving me an easy ball here, right? Because in this case, Uniswap actually won the case because the court held that Uniswap is not liable for the people that are selling the tokens, the shitcoins on the Uniswap, because Uniswap does not control who can trade and list the coins on the Uniswap. They only, and the court used the analogy that Uniswap actually like a road, like the manufacturer or the constructor of a road, and all other protocols and shitcoins are the cars that are traveling this road. So you cannot hold liable the contractor who built the road for the cars that got into accidents. It's not their fault unless the road was really bad. All right, so and then we have those questions. The problem with a decentralized finance is it's only limited by the blockchain and crypto assets within the blockchain economy, which is Bitcoin, Ethereum, and certain other assets. And the natural idea for people in the crypto was to expand the total economy of the assets within the blockchain world, which led to the idea that we need tokenized so-called real-world assets, or RWA, real-world assets. And that's led to that somebody came up with the term tokenization, and nowadays tokenization is used for actually artificial intelligence and for those large language models. But anyway, the concept of tokenization is keeping a record and execution of title transfer over an asset with the use of blockchain. I'm confusing the slides a little bit, sorry. That's, I already discussed. So the idea of tokenization is that you keep the record and execute the title transfer over an asset with the use of blockchain. And to better understand this, we should look at the different stages of evolution of finance industry. The first, that's the chart actually that I borrowed from Oliver Wyman, the big financial consultancy. I think it represents in a really neat way the evolution of the finance industry. So historically, the record of assets was kept on a paper-based instruments held by intermediaries. And the exchange or the transfer of value was occurred on physical venues. Let's say you go to the market, you want to buy a piece of real estate. Back in the days, you make a transaction with somebody else, you write it down, maybe there is a public notary who would certify that the transaction was done, and that's how you acquire an asset. And that's the old form, probably back in before 19th century, somewhere there. Then the second form is electronic form. That's the world we live right now, where the record is kept in a digital form, but in different distributed systems. Let's say you have an exchange database, you have a brokerage database, you have a central depository unit database, and those databases need to reconciliate, and that's why you have T+2 or T+3 time for settlement, because all those databases need to send information to each other and settle all the transactions. And the transfer happens on separate different platforms. Nowadays it's more like on a brokerage account. If you open a broker account, they will send a message to the exchange that you want to buy something. So you have a lot of different systems and elements that need to work together, and each of these units is regulated by their specific regulator in the jurisdictions where they're based. And the idea for tokenized form or so-called decentralized finance is that you have a single ledger that both tracks the record, who owns what, and executes the transaction and the transfer of between the balances within this large digital ledger. And the idea is that it's supposed to be much more effective than the old way, where all the systems were spread around and may have required certain, several days for reconciliation. This is supposed to be a new, more efficient form. And the natural idea was, let's put trademarks, real estate, securities, bonds, houses, everything on the blockchain, right? So why not to have everything all together at the same time on the blockchain? And the problem with that is that most of the world's assets today are tracked in registers that are controlled and authorized by nation states. For instance, cash balances. If you have a cash balance, that's the bank that keeps the record of your balance on the bank account, and this bank has a license from a government to do that. And they actually ensure that you cannot double spend your money on the bank account. If you look at the public securities, there are certain specific entities like central securities depositories, brokers, and exchanges. For the private securities, it's even worse. There is just there is a state register where, let's say, if you want to sell a piece of share in a BV company or like LLC or GmbH in Germany, you need to go to the notary first, and then the notary makes a filing to the state register that will affect the transaction and the transfer of shares in LLC and private companies. The same with real estate. It's tracked in state registers, and trademarks. Not so for the copyrights and private contracts because they tend to not to have any public registers. And for the tokenization of real-world assets to happen, we need the governments to agree to give up the control of those assets. And no government actually want to do that because that's the definition of a government, that you control and have a monopoly of the transfer of valuable assets within its territory and within its jurisdiction. I can actually show you, but there are a lot of progress in this world. I can quickly show you the website where you can track how the tokenizations of the world assets actually goes. That's I think a great website that visualizes all the tokenized assets in the world right now. And the first thing to tokenize was the private credit, essentially loan agreements. When I issue a loan to somebody, I can sell those right from the loan to somebody else. And there are now approximately 600 million of loans tokenized on the blockchain. The second one was the second largest, the biggest one is US Treasuries. So you can buy US Treasuries, which deemed to be the most conservative investment instrument. You can buy it on the blockchain, but you need to go through KYC and everything, so it's not that easy. And the third largest tokenized asset is cash. Stablecoins represent a tokenized cash, which we're going to talk in more detail a little bit. Right, and then I think if you want to learn more about this, you go to this website and they have a lot of helpful information. And the fundamental question here is whether the governments, the nation states, will give up control over existing traditional assets and their registers. And I don't think it's going to happen anytime soon because there is no incentive for the government to do that. If you control the assets within your territory jurisdictions, it's a great, advantage of a government, right? A great tool. And the final thesis within the idea of smart contracts are so-called decentralized social networks and decentralized reputation. And I think that's where the most interesting things are going to happen in the next 5 to 10 years. I think that many students in the audience probably traveled from abroad here. Which of you used car sharing application where you can rent a car? Yeah, car sharing. Only one. Yeah, several persons. Like, let's say you use a car and you need to build up your ranking in the car sharing application, right? The better you drive, the more compliant you are with the speed limits, the better your reputation, the better car you can rent next time, and probably the price is also better. And then when you move to the Netherlands, you figure out, first you figure out there are no car sharing applications in the Netherlands. The second, even if there were, that you need to build up your ranking again. Right, because you cannot export your reputation from one app to another app, and that's how apps build the guardrails for the users to keep them within their ecosystem. It doesn't make sense because if you move to another country, there is no, the same car sharing application. You can't use it. You need to build it again. The same with credit scoring. I once moved to live to New York, and in order to rent an apartment, I needed to present my credit scoring ranking. in the United States, nobody wanted to accept my local from my country because they just didn't accept and they didn't realize that there is another country in the world. So my credit scoring from one country was not applicable in the United States. And that's what you call a social reputation. That's all the data points that are held in different databases. Maybe it's a car sharing app or it's a system in the credit bureau, a record in the credit bureau that tells your that stores your credit scoring. Those things exist nowadays in those centralized, they call it federated registers, and are not easily transferable from one country to another. And then the next example is. All of you, I guess, have social networks, and let's say you have your own friends and you move to the Netherlands, you want to set up a Facebook account and you have to do it from scratch, right? You have to get all the friends, you have to invite everybody, you have to build your, like all the different groups and chats, join the chats, and that's, if you think about it, that's nonsense because you, again, have to do this from the scratch. Let's say you made a lot of valuable content in Brazil when you lived in Brazil and you moved to the Netherlands, and then you earned a lot of likes and reputation or karma points, like karma points in Brazil. Then you move to the Netherlands and you have to start from scratch, right? You don't have any karma points here, and nobody really thinks you don't really have any friends here, and that's what is called a social graph. Social graph is essentially a combination of all the connections, likes, posts, maybe music collections that you accumulate along your life, and that you actually gain, and then that maybe even define you. So again, those things nowadays, they live in a centralized database of Meta, Facebook, Instagram, or any other social network. And blockchain actually is very helpful and suitable here because those data points can ideally and perfectly be stored in a decentralized decentralized database. And in the same way, we compare it like a decentralized exchange and interface. In the same way, you can build a decentralized database with all your social graph and social reputation and an interface that taps into the data that is associated with you and that you own, so that you move from one country, you don't have to prove your ranking again that you can drive, a fancy BMW or any other car. And that's there are certain applications in this field, and I think that's the most interesting thing that's going to happen in the next couple of years. And the bigger questions here are whether existing social media companies will give up monopoly over their social graphs, and obviously, just like the States, they don't really have any incentive because they will lose all the audience. And what will be the new structure of the internet where social graphs are owned by users and not and now easily transferable from one application to another application? It probably should lead to the bankruptcy of social media companies, but of course they will adapt, so it's not, they're not going to lose. There are some rumors that Twitter is thinking of decentralizing their algorithms. They actually already open source their search algorithms, but they're also building maybe a version of a Twitter that where you can export all your subscribers and all your tweets from Twitter to another app. But it's just in the works. We don't know if it's going to happen anytime soon. So these were the 5 main theses without smart contracts, and the 5 or a little bit more fundamental questions within the concept of smart contracts. The final topic is stablecoins, and what is the stablecoin? The stablecoin is when you go to, let's say, institute, you give cash, the institute gives you back a token, right? And then if you want to exchange this token back to cash, you go to the same institute, you give a token, you get the cash back. It's very helpful, and the idea really took off. One of the speakers, I think, right, you said about this, that the idea for stablecoins took off when traders needed a stable reference value to trade crypto assets, right? Back in the days when you trade on Binance, let's say 2014, Binance did not have a USD accounts. You can't really exchange your crypto to USD or Euro or anything else. You can't really withdraw to cash, to fiat currencies. But you needed some sort of a value. If you want to trade Bitcoin, you need to fix your value against dollars. And that's why exchanges came up with the fictional dollars, and they call it like a fictional balances. And then these led to the idea of stable coins, when this is like a fictional number, but you can actually go and exchange this stable coin back to the dollars if you want. But nobody really wants to do that because it's just a fictional number that exists out there. That's primitive graph on the screen that you can see. But the idea really took off, and nowadays there are approximately 150 billion stablecoins in circulation, and there are two dominant ones: USDC, which is a US regulated stablecoin, and USDT or Tether, which is a less regulated non-US offshore stablecoin. And they tend to compete. I think that's a competition between, West and East, and the global competition between two paradigms. The great thing about stablecoins is that you don't really have to go to the bank. You don't need a bank to have a stablecoin balance. These are the three most popular wallets in crypto: Coinbase Wallet, MetaMask, and Zerion. Zerion is actually one of our clients, so I always put them on the screen to promote them a little bit. That's the fundamental idea here is banks and your cash balance in the banks are no longer necessary. Because if you have like a stable coin, you can use an application that is not regulated, that does not do QIC, or does not do any investigations, and it's much easier to open a crypto or like a wallet account, and you can hold, buy, and transact stable coins without being the traditional financial system that tends to be quite complicated. And that's stablecoin, I think, represent the idea that at a certain point, probably they will compete with banks and payment service providers like Visa and MasterCard. And we already know that because Visa and MasterCard are a little bit anxious about that, and they developing their own stablecoins because they understand that they represent a big competition to them. Right? Yeah. Will stablecoins eat the lunch of banks and MasterCard, Visa? And will USD-backed stablecoins compete with local currencies? I can tell you that in certain economies with unstable local currencies, stable coins are a great store of value for people. For instance, I know that in such countries as Argentina, Russia, Turkey, where national currencies tend to fluctuate a lot over the last 10 years, people really use and love stable coins because the value is back to USD or US dollars, which is deemed to be the most stable currency in the world. However, all the stable coins nowadays are backed to US dollar, and US dollar tends to inflate itself because the Federal Reserve, the central bank of the United States, can print a lot of money because, for instance, during the COVID, they printed a lot of money to fight the consequences, the negative impact of the COVID. And after that, inflation began for US dollars. And the big question, the interesting question, it's more of like a startup idea, is it possible to create a stable coin that's going to be pegged to a more universal measure of stability, which is not a nation-state currency, but more like a basket of goods and services. And in order to do that, you need to create some sort of a mechanism that will track the value of different services and goods or in the world at the moment, and sort of connect the value to a specific stable coin. Because today stable coins are as stable as United States dollars. So if United States dollars are subject to inflation, that your stable coins are also subject to inflation. Right, and that's the end of it. Yep, I also have like a bunch of slides about top 10 crypto law highlights of 2023, but that's probably too much for today.
Maybe we can ask if there are any